Hello and welcome to the August webinar special. We are providing live FX market analysis. My name is Ed Moya. I'm the Senior Market Analyst at OANDA. And most of you are used to having Craig Earlham join in on these presentations. He is on holiday today, so I will be taking an in-depth look at what events are taking place in the month of August, highlighting what some of the key drivers are. Obviously, we'll talk about the trade war. Central bank easing is going to be a topic that will be discussed for probably the rest of the year, and also we'll touch upon Brexit and what is unfolding in the currency markets. Once again, this is an interactive webinar special, so please definitely post your questions. If you have anything you want covered, any particular currencies you want reviewed, we'll be more than happy to do that. First, we'll take a look at some of the key events, and then we'll take a look at the charts. And right there, you should see the MarketPulse website. This is where the team puts all of our market analysis, our coverage. We provide up-to-date open notes on what's driving the specific currency moves for that day. You'll notice we'll also provide some additional commentaries on specific themes in covering all the major asset classes. We have technical analysis that we also provide, and you can pretty much just at your convenience look for whatever is moving the markets. You'll see we have different tabs for you there. Also, we have our economic calendar, which will outline all the key events that are taking place that day, that week, or the month, and you'll be able to easily track it all from the MarketPulse website. And also, you can follow the MarketPulse team on Twitter. We provide our any major market move. We'll provide extra tweets, interaction with other reporters. You can see it all on Twitter. My handle is at EdJMoya. It's EDJMOYA. You could also follow Craig Earlham. His is at Craig_Forex, and also Alfonso Esparza. And on the left-hand side of this page, you can see their respective handles. And also for Asia, we have Andrew R_Forex. You'll see the whole team is actively tweeting throughout the trading day, and at times you'll see we provide links to specific articles that we're getting quoted on, or particular fast-moving market moves that we're just providing a little bit of our insight. So today's webinar is the big look ahead as far as what is driving the Forex market in August. There's typically, you have August, and many traders, they kind of have the just go on holiday mode and anticipation of lackluster moves. But because of this trade war between the U.S. and China, we're seeing some extremely volatile swings. We're seeing the VIX jump up several percentage points, and we're having everyone focus on whether or not this trade war will be ultimately resolved before the 2020 election, or if China's going to wait this out. So there's a lot of things that are going to be important to follow, to track, to see whether or not you might start to see one of the countries be more inclined to blinking first, and possibly helping bring back trade talks to a more constructive level. So you'll see trade is going to be the primary focus for many traders. The other key aspect too is when you take a look at trade, you're going to see that many people are looking for the reaction that you're going to see from the respective central banks. Many traders have been closely following the Federal Reserve's interest rate expectations. This is a topic that Craig and I have debated over the coming months. With the whole MarketPulse team, pretty much you could say that I'm probably the most dovish expector of what will unfold in the coming months. economic data will be plentiful in the next couple of weeks, and I think it'll provide us with some cues as far as what we can expect. Everyone knows when the Fed meets, it's pretty much growing expectation that September is going to be a big month for a lot of the major central banks. But one of the things that many people forget is that the PBOC, they've been easing, they've been supporting their domestic economy, and when China eases, it really does provide a bid for Asia. It's also something that is not on schedule. They typically, historically, we've seen them intervene in illiquid times. They get more bang for their buck. They provide at times during late summer, lackluster sessions. So typically we've seen some significant easing moves by China, and on a late Friday, and at least late for Asia. So it is important to know that if you're letting your trades go, that you be aware that we could see a significant move by the PBOC, and the expectations are growing that they're going to do something extraordinary, and that will be something we'll definitely possibly see happen this month. So lots to focus there. The other key event that I'm actually going to cover closely is the Jackson Hole Symposium. It takes place right before the G7 summit, and one of the areas that I think many economists, analysts, they're all talking about is, the Fed's last rate decision, was it a policy miscommunication? So you're gonna, and we'll dive in deeper on all these topics once we get to the charts. But I think one of the big events that we could see is Jackson Hole could be the platform where the Fed decides, let's go ahead, let's kind of clarify the last rate decision and the expectations for easing. And I think right now the markets are, and the markets have been pretty much expecting a lot more easing than the Fed's been signaling, and we could see Jackson Hole once again be a pivotal moment for the Fed, where they'll provide a clear correction in that policy miscommunication. So we'll see that happen towards the later part of August, and then afterwards you have the G7, and the G7 typically, the expectations are pretty low that we'll get anything substantial from there. We had the U.S. label China as a currency manipulator. The possibility of having other countries come on board and have the G7 issue a statement where they kind of join the side of the U.S. is unlikely, but you will see lots of comments. You'll probably see further pleas from the U.S. as far as making things become more balanced on the currency side of things. So it will be fluid with commentary from all the key officials. So definitely you'll want to pay attention to these key events. These could be major drivers for the currencies and also risk assets. So what to watch? There's a lot of events happening. I have it in columns of what's taking place in the remaining weeks of August. You can see that tonight we do have a rate decision from the RBNZ. The expectations are that it's go time. They're going to go ahead and continue with a 25 basis point rate cut. Once we get to the charts, we'll dive in a little bit deeper, but for New Zealand, it does seem like it is a done deal. Later in the week, on tomorrow, we'll have also a rate decision from the RBI. The scenario is pretty much similar to New Zealand. Another rate cut is expected from them. You'll see that the rest of the week, there's going to be critical data from Germany. Recession concerns are growing for Germany. the worse off we see Germany, the more likelihood we're going to see a significant wave of easing from the ECB. The the largest block in the eurozone is ultimately going to dictate how much easing we get. So this is going to be a key figure. Continued weaker prints from Germany are going to really raise those easing bets for the ECB, which are already heavily priced in. And then also too, we paying close attention to crude oil inventories, as many loony traders follow. Um, the supply and demand side of the oil trade. We've seen continued drawdowns from the U.S. inventories, and the latest report from Cushing is that we could see another one this week. So very volatile for oil prices. Oil, did see a lot of weakness recently on the trade war affecting the global demand concerns. So if we continue to see drawdowns with U.S. stocks, this is going to provide oil stocks, that is, this is going to provide possibly some support for oil, which could also translate some support for the loonie. So definitely want to pay attention to that this week. And then also the trade balance data for China. There's no set time on when that happens, so it's going to be around Thursday. Typically, this event is going to be something that everyone is going to pay close attention to. How much weaker are imports and exports going to be? The trade balance is expected to shrink, but we're looking at the components. The components are steadily decreasing. The trade war is hurting China, so you'll see that if we have worse readings than anticipated, it just goes to that argument that the PBOC is probably just around the corner. And then also too, we'll get some good readings for economic growth from the UK. Right now, everything is about Brexit for the UK, but pretty much all the central banks are in easing mode, and right now, just waiting for the Bank of England to finally join that camp. And once we start getting further weakness on the economic readings out of the UK, this will raise the bar for rate cuts, and we'll cover that a little bit more in greater detail. But Brexit right now, the primary driver for the British pound. PPI for the U.S. on Friday is also going to be an area that the Fed is data dependent. They are focused on inflation. This is not their preferred metric that they follow, but it would provide a little bit of insight as far as overall inflation pressures. How are they doing? And we'll be tracking that, because if inflation, which has not been near their target for some time, continues to soften or drops off significantly, that would definitely be everything the Fed needs to commit to that easing cycle. So definitely an important thing to follow. Next week, you could see a lot more data points to follow. You can see it's heavily focused on CPI readings, current surveys as far as German growth on Tuesday. That I think the ZAW is going to be one of the ones that is more closely watched. So you'll get an overall expectations. How things are. Global growth concerns, is nothing new. But if we continue to see things get much worse, the raising of the easing bets are going to be one thing that everyone is going to know the central banks are going to follow and have to react to. So I think some of the standouts will be the China industrial production and retail sales data on Tuesday night. You can see that there's always a constant flow of data, and right now, in addition to your tweet decks and following all the latest updates from the trade war, whether it's from President Trump or from China, we're going to see that the data is starting to weaken globally, and it's not about if these central banks are going to be easing. It's about how, how much they're going to be delivering and signaling. So that's going to be a key thing. And you can see that when we take a look going into the rest of the month, lots to cover, and you'll see that the overall theme is going to be for the U.S. It's going to be about the strength of the U.S. consumer. It's going to be about inflation data. If those start to weaken, you will see the Fed be ready to deliver easing at a much greater magnitude than they've signaled. So right now, markets are expecting the Fed to possibly deliver an additional couple cuts. Some are calling for 3 rate cuts, which, when we take a look 2 weeks ago or even a month ago, there was belief that maybe we're going to see them be one and done. So everything is reacting to this trade war, and we'll definitely see central banks want to maintain a cautious stance, but everyone is data dependent, and we'll look to see these potential reports provide some clarity on the magnitude of the easing we'll see in the coming months. Okay, great. So we're going to take a look at the charts next. If you guys have any specific questions, I pretty much will be covering the majors, and also we'll be touching upon the Chinese yuan. So just bear with me one moment while I change the screens, and definitely just put out any topics you want covered. So hold on one second while I change the screens. Okay, great. So everyone should be seeing my charts. If you could just confirm that you do, that would be great. Wonderful. Okay, so the first chart we're going to take a look at, because right now everything has been about the trade war, and we did have a very interesting move. We had the Chinese yuan break the very critical 7 handle, and the decision that China made in allowing their currency to weaken was one as a specific response to the latest threat from President Trump. And as the trade war continues to intensify, we're going to see China and the U.S. kind of trade blows here. So right now, everyone is expecting the rhetoric to remain tense. The markets did have a little bit of a rally. We did see safe havens kind of ease up a little bit on last night's development, where China they made the fixing of their currency not as strong as or not as weak as many anticipated. So we saw, we did see the Chinese yuan pull back a little bit. Still, they are weakening. They have been depreciating their currency steadily. And many people are asking, well, why are they doing this now? And mainly it's because as President Trump increases these tariffs, the devaluation of the Chinese yuan is really much just kind of eating up those tariffs. So the next stage of the trade war is going to be where we'll see China probably try to make life a little bit difficult for U.S. companies. We'll also see China possibly try to really mess with some of the key manufacturing in the U.S. with the delay in possibly delivering rare earth materials, which are used in manufacturing various goods. So the potential here for things to get a lot more tense is out there, and that's why you're seeing a lot of this flight to quality. Um, the and right now we did see the Chinese yuan be a good gauge as far as where this trade war is going, and the potential upside here for the Chinese yuan is and many economists are targeting that if, let's say, we did see another 3% of weakness here, the Chinese yuan could provide a move up to the 730, 750 region is what some are talking about. The ultimate way this could play out is, as long as the trade war is remaining tense, we could see yuan depreciation, and then this is the big debate, though, is when, and I think most economists believe that we will eventually see a trade deal. And when that happens, you could see a violent move here. If you're optimistic that there will be some type of another trade truce or improvement in the dialogue between China and the U.S., this one-sided trade could quickly evaporate. China is if they were to let their currency free float, it would be a lot weaker right now. So these calls for China being a currency manipulator, it will be debated by many, but for where the World Banks and the IMF will take a look, it doesn't really kind of make all the check boxes as far as really deeming them a full-fledged currency manipulator. We're seeing it depreciate. It is not being devalued specifically, so it's semantics. It will dominate a lot of the headlines, but for many, the Chinese yuan is going to be a trade that will be very interesting, because once we get to that 730 level, that's where many anticipate we could see it reached by the end of the year. So definitely one to follow if you and most FX traders, it's kind of on the radar but not actively traded. So the break of 7 really reinvigorated a lot of that interest. So we'll see how much longer this bullish move up higher can be sustained. The next currency pair I want to take a look at is the dollar yen. But with dollar yen right now, it's basically a strict safe haven trade. Trade talks fall apart. Fed disappoints. We see a stronger yen. The yen has not traded on yen fundamentals for quite some time, it seems. Eventually it will, but right now it is all about safe haven flows. When we take a look at the Japanese yen, we're looking at that 104.50 region as very, very key support. There's been a little bit of a move up here, and let's switch this to a daily chart. You can see that the bearish trend has been firmly in place, trading comfortably below the 250 and 100-day simple moving averages. It seems that we're constantly in oversold territory, but the macro drivers are what has been keeping this trade going. And right now we did see some tentative support here, but for me it's 104.50 is the key support level that if we did see further weakness, I would look to see some semblance of support here. The overall risk on, risk off area is likely to continue this trade going, but as I think the market has been very scared by the trade war, and when we take a look at the overall driver, the trade escalation is likely to continue. And with no face-to-face talks between the U.S. and China until September, we're likely to see some thin conditions here where we would possibly see some exaggerated moves and also short squeezes. So I think that the overall directional bias, is still pointing to the downside here. But if we do get some easing of these uh, um, worries with this trade spat, whether it's China deciding to possibly commit to resuming some agricultural purchases, whether Trump kind of takes back some of the increased tariff threats, you could see markets eagerly respond to returning to risk appetite, because ultimately, once this trade war is behind us, you're going to have the global easing efforts from all the advanced economies in China providing a bid for risky assets, and typically that should be very bearish for the Japanese yen. So we'll look to see once we do have a resemblance of an improvement in this trade war, where you could start to see dollar yen make a run back towards the 108, 110 region. We're probably a long way from there, but ultimately the overall trade with the dollar yen is possibly going to see the U.S. consumer provide a strong reason to want to own U.S. dollars, and the U.S. economy is still strong. It's in the latter stages of of record long expansion, but it's still going to be a comfortable area for people to park their money. And when you have the rest of the world possibly giving you a negative return on their government debt, U.S. Treasuries will provide ultimately a good reason why you could see some longer term support here for dollar yen. Okay, so the next currency I wanted to take a look at is the Kiwi. Many people, when you take a look at the Kiwi, you could see that we have a rate decision upon us. Everyone has been pretty much in easing mode as far as over in the other half of the world. The last time New Zealand central bankers met, the last time they cut was back in May, and we're looking for a stronger signal that we could see we will see a rate cut most likely. We might see more rate cuts coming down the road. When we take a look at some of the key metrics, the consumer is not too strong. We're seeing declines in confidence, credit card spending. New Zealand has been, if you follow the Kiwi, you're following food prices, you're following commodity prices from New Zealand, and then lately it's been pretty bearish. And housing is another concern for them as well. So the health of the New Zealand economy has been hurt by this trade war, and we're likely to see continued pressure here as the easing floodgates have been lifted. I think 64.50 is the key area right now. This is it's a pretty bearish chart. You could just take a look at how high we were early last year to where we are now. The 64.50 level is going to be the key area that I'm focusing on. If we do have any optimism on the trade front, the potential return to a confluence of where we have our simple moving averages around that 6600 to 6650 region could provide key resistance. But right now it's difficult to make a strong argument for a stronger Kiwi when you take a look at just their domestic economy, the overall worries, and I think that many traders, kind of lump the Kiwi dollar along with the Australian dollar in that as they're very reacting to the developments in China's economic growth. So you can see when we take a look at here, the Aussie dollar, another extremely bearish chart. Aussie dollar has, the bearish bias has seen consecutive lower lows here. We are not seeing any strong support. I think when we take a look at if we do continue with this strong trend, initial support we could see around that 67.50 region, then followed by 60, 65, 60. The excuse me, the oversold conditions have are screaming that we could see a little bit of a short squeeze. But right now, major resistance is going to remain that 70 level. You can see that has been heavily tested, earlier in the year. But just another casualty of the trade war right now is the Australian currency, and you could see if we were to take a look at more of the currencies in Asia, it's a similar story. Next, definitely want to cover the euro dollar. I know with the euro, many traders have been enjoying the tight ranges. Just range bound for the most part, not necessarily providing some of the more traditional reactions. Last week when we saw the Fed deliver on a rate cut, and we take a look at the developments. Typically you would expect to see a much stronger euro, and right now we're kind of just hanging around that 112 area. I think you're seeing the Fed is, the markets are screaming that the Fed's going to cut a lot more, and we very well could see in the coming weeks the Fed also kind of join with that view. But the ECB is likely to have to provide further stimulus, which they were hoping to. The German Bund is kind of like a good tell for that. We're seeing negative rates in Europe. This is not good for banking. This is not what they want, and the continued weakness with Germany is going to raise those calls for stronger, aggressive measures. We could see the return of QE. We could see, in addition to rate cuts, we could see when Christine Lagarde take over as ECB chief after Draghi's term ends in October. We could see a strong push for fiscal action from the Eurozone. So there's going to be a big expectation that we're going to have more stimulus coming here. But for now, you can see that it has weighed on a lot of the European assets, and that's an area that if we do have the Fed signal much more easing, I think that would still dominate the whatever next bazooka of stimulus that the ECB is going to provide, because the Fed, they just ended their tightening cycle. They're just starting to commit to easing, and I think that the where you see the Fed's going to be focusing on is they're going to want to make sure that they don't end up like the Eurozone or Japan. They don't want to have negative interest rates. And right now, if they're aggressive now, we could see the U.S. Avoid having to go that route. So, many people forget that just not too long ago, the German Bund was positive, and now we're, over 50 basis points negative. So it's very important to track the key yields, and right now the Fed is kind of being handcuffed into delivering rate cuts, and that's why we'll be tracking a lot of these inflation gauges in the coming weeks, because that is what might help convince them to signal much more cuts are on the way. And if not, then this could go down as one of the biggest policy mistakes from the Fed. So we'll see if that will provide a little bit of a bid here for the euro. So the range, unfortunately, is still intact here, but we could see, for the remainder of the year, that 110, 114 be a much more wider range where we could see the currency trade. And right now we are seeing some initial resistance here for euro dollar, just right around the short-term resistance at 112.50, and then we just below the 113 handle, we have the July high. So it will be 110 is kind of the line in the sand right now for the euro, but the prospects of just much more dovishness is likely to keep this currency somewhat trapped. But if we do have the Fed deliver a clear communication, and that's why I got that Jackson Hole event in the later part of August circled, where we could see that be the point where we could see euro dollar have a strong move there, and if we do recapture the 200-day SMA, we could see that move to that 114 level, and ultimately longer term, I think that the dollar could see enhanced rhetoric, that maybe more verbal intervention than anything of substance, but we could see that provide it with some pressure for the remainder of the year. So that's kind of the outlook for the euro dollar. Great, and we can't have a webinar, and Craig would definitely want us to cover the British pound. The British pound has been pretty much hammered by this no deal risk, no deal Brexit risk, and right now the economists, you'll see that no one is really trying to say there's a set base case. There's many outcomes that could happen. Rate cuts, not even being really discussed right now by the BOE. This is all about Brexit. If we do see Boris Johnson get the UK out of the EU with a no-deal Brexit, that will spell possible disaster for the British pound. Currently, we are seeing the potential ranges that we could see. The ugliest of no-deal Brexits could see 105 possibly tested, and if we do see PM Johnson deliver a Brexit withdrawal agreement here, and have them exit in an orderly way, we could see price back up to 133. So the situation is tense, and right now the concerns are that he's not going to be having an easier time than he was hoping for. The opposition, Jeremy Corbyn, is going to have that confidence vote when recess ends, so early September. He'll make the call for that, and then we're going to see the risks grow that eventually we could see a general election, maybe another referendum. So Brexit is the story. There's just too much volatility right now. Now, for For the short-term traders, though, you're looking at 120 as the key support level. So even if we do see some of that rhetoric, we're not expecting anything conclusive in the coming weeks until we get to September. So you could see 120 provide major support, but obviously anything that provides significant clarity on Brexit will could easily break that level. But yeah, so right now the oversold, the lower lows that we have steadily seen, and are keeping the pound way heavy. But and typically when we see a chart like this, there is growing short interest, and you're always subject to a possible short squeeze here. So I think the way Johnson has lost some momentum since he took over with regional elections. His majority is now like about one vote or so. So there's growing concern that he will have a harder time than Prime Minister May did. So Brexit will be a situation that you'll see us constantly cover on the MarketPulse website. Great, and so the next chart we're going to take a look is dollar CAD. You can see right now we are seeing it consolidate right around the significant confluence of the moving average resistance. The currency pair has, for the most part, here turned a little bit bullish. We are above the 50-day SMA. We've seen oil prices sell off significantly. I think that when we take a look at some of the overall ranges, the Canadian dollar has not really traded much on the expectations of the Fed's easing cycle. We are seeing it trade a little bit more heavily on the reaction to some of the oil prices swings that we've seen. The Canadian economy is actually one of the strongest right now in the major currency pairs, and right now we are looking at a possible reversal if we do see the trade banter ease up. If we do have oil prices find some significant support here. Right now, oil is at a very critical level. You're going to see many geopolitical risks provide a bid here for oil. So we're looking at dollar CAD as a trade that could eventually see loonie strength in the longer term. But right now you can see that the trend, we are starting to see a much more bullish move here, and if we do see price rally back towards this 135.50 to 13600 region, that would provide major resistance here. So right now the short-term outlook is a little bit choppy here for dollar CAD, and right now you can see on the stochastics down below that we are definitely seeing oversold, overbought conditions here. So when we take a look at just going back a little bit further here, you can see that the overall bullish trend did break here, and the potential here of this little bit of a rebound here could if we don't recapture 135, then we could see a stronger pullback here, ultimately long term possibly targeting that 130 handle, and if we break there we could see 127.50 be targeted. So you can see the longer term chart has for the most part been very nice technically set up one as far as seeing major significant pullbacks and reversals here. One of the next currencies I wanted to take a look at is the dollar Swissy. Oh, and just getting a quick question here with regards to the stochastics part of the chart. It's a no buy sell area. Typically, with stochastics, there's many ways you can use it just for strictly overbought, oversold. Sometimes I try to emphasize more when we see some divergence, but typically, you know, when we do enter extremes, so whether it's on the overbought side, just you know, above the 85 level is typically where you start to see some traders focus in on that potential reversal here, and on the downward side, you can see just around the 15 area as being a key turning point as well. For me, ultimately, I look at trend and look at the also key Fibonacci retracements, and in particular pattern recognition, as far as dictating where I could see potential reversals or continuations of trends. And if there's a specific currency you want me to dig in a little bit deeper, I'm more than happy to. For the next currency pair, I find dollar Swissy as a very interesting setup here. Dollar Swissy has provided us with, you know, just like the Japanese yen, that key safe haven trade. But more importantly for me, when we take a look at monetary policy historically, and this has been a very strong historical analysis I did, is that when we have the Fed enter an easing cycle, and right now we only saw a 25 basis point cut, not nearly enough of a sign that it's an easing cycle yet, but when the Fed does enter an easing cycle, we typically see the Swiss franc appreciate the most to the dollar. So this is an area that if we do have those dovish bets come to realization here, we could see 9,500 as a short-term destination. I think ultimately when we take a look, and let's just take, and right now we're on a weekly chart, but you can see that the market has definitely seen major resistance just above the parity level. It is possibly going to be an interesting trade, because you're going to see the SNB step up their intervention efforts. They, you know, don't want to have their currency too strong, and you'll typically see that more reflected on EURUSD. But as we have the Fed deliver their easing cycle, I'm thinking you're going to look for in the short term 9,700. Once this level is if it is breached, we could see that initial move towards 9,600. 9,500 is a key area where you might have some longer term support, followed by possibly the 92 region. So bearish is where we could see this unfold. However, if the trade war collapses, I think you're going to see an interesting trade here, because you see a much more violent move lower, and if we let's say we do get a trade deal, and if we do have the Fed just deliver just a possible one more cut, and just eventually, if we do see an economic rebound, we could eventually see this, become extremely bullish. So the prospects right now, though, the argument, more easing from the Fed, and then just the overall risk-off trade is gonna what makes dollar Swissy be an attractive bearish outlook. So right now you can see it's trending nicely lower. It is tentatively finding some support here, but if things play out the way that they could with the Fed, we could see that bearish move accelerate. Great, and I think one of the questions I have is with regards to the Fibonacci tool. Let me pull up. I did also have a question on gold, so I'll do an example here with our gold chart. Okay. And my screen is a little bit cut off here, so I might need a couple of, I can't quite see my indicator list here. 1 second. Bear with me 1 moment. All right. Okay, right now what I'm sorry, the go-to software right now is not agreeing with my mouse as nicely as I'd like it to. So typically with my Fibonacci's, I typically like to look for a significant low to high move. Right now you can see on the gold chart, I'm going off the record, one of the more recent record highs, and just to the key low here, and you can see the Fibonacci levels that I use for an immediate pullback, the 23.6 level, 38.2. When I'm using Fibonacci patterns, I historically have used the 127.2 expansion level and the 1.618, the golden level. So you can see that right now when we take a look at the current move in gold prices, we have seen a very strong breakout here. When we go to the daily chart, you could, just gonna have to resize this for a second. There we go. You can see that here we had an somewhat of a formation here of an ascending triangle. Typically you're seeing some lower highs, and you're seeing just a key respective a key resistance level. So this was typically, and with technical analysis, you'll notice, especially nowadays, there's never a perfect pattern, but typically when you see this steady congestion here and these higher lows, and you could see that this was a definite key resistance area. This breakout, which was one that we definitely covered on the MarketPulse website, just highlighting the trade worries, the easing bets expected from globally, that we were going to possibly see a breakout, and you could see that acceleration here. When we take a look, well, how much higher can it go? That's when we use our Fibonacci's to identify that. So you can see that here. If we do take out 1500, the next major level could be around that 1580 to 1600 region, and then further upside could eventually target that 1700 region, and that's kind of typically how you'll see the some traders use Fibonacci. One of the other patterns that I use is the Fibonacci drawing tool where, and you can see that we have various patterns that you can use. Here we have the XABCD pattern. So earlier in my career, I studied with Larry Pesavento. He wrote a book, Pattern Recognition, like using Fibonacci. And you could see that typically what you would do is try to identify key low to high moves. And you would look for pretty much a confluence of resistance here. So at times, trying to get the 141.1, and so like right now, so on the X to A move, you could see that the Fibonacci expansion level is the 100, close to the 141.4 expansion level, and the B to C move is close to the 161.8 level. So typically this pattern you would use as a possible signal that, okay, we could see a reversal here. So if price hits the just right around that 1500 region. So some traders use this as the strict as their entry for selling. Some will use it as, okay, well, if I'm long this particular instrument, I will look for a reversal there, so I'll try to exit out of my trade. So that's kind of how I like to use Fibonacci and some of the other key drawing tools that we offer. And just to kind of follow up on that, the key area is, you know, I always look for a significant low to high move, and then you can also, you know, the one thing that with these patterns, you can, you know, you don't always have to use the longer time frames. Typically, historically, I like to use them on the daily charts, the 4-hour charts, but you can go as low as 1 hour to 5-minute charts. And that's where many traders will like to do it. Some of the other patterns that I've used is 3 drives to a bottom, 3 drives to a top. There's the double bottoms, the head and shoulders, inverted or regular, where you could see that used. So you would use the Fibonacci levels to confirm the head and the shoulder and the other parts of those patterns. So if that's an area you guys are interested in too, I could look to set up a special webinar on just that. So definitely let me know if that's a topic you guys would love covered. Okay, great. Yeah, thank you. I'll definitely make a note of that, and we'll provide. We'll look to provide that hopefully sooner on the schedule. So great. Seeing lots of interest there. So I'm having the September agenda set up soon, so I'll definitely look to deliver that for you guys in September. So thank you. We are in overtime, so I apologize for running a little bit long. If you guys have any questions, definitely just message me. You can also tweet at me too. More topics, more questions, more than happy to. You know, thank you all for attending. I want to wish you good luck in your trading, and this will be on the YouTube and probably in the next day or two. So definitely, if you have any, if you wanted to play back any portions, definitely we'll have that there for you, probably on YouTube in the next day or so, and also on MarketPulse.com. So thank you all for attending. I will see you guys next time.